Hello, I'm Bill McIntosh, a managing director at Peregrine Communications in London. In this edition of the Peregrine podcast, I'm joined by Robin Wigglesworth, FT Alphaville editor and author of Trillions, which was published by Penguin Random House in 2021. Trillions looks at the past, present, and future of passive investing and how it is reshaping financial markets. It's a fascinating, hugely informative, and compelling read, and I'd argue a must-read for people in asset management or anyone hoping to develop a career in the industry. The subtitle of the book, How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever, really captures the scope of the story. It also points to the role that some key personalities, notably Vanguard founder Jack Bogle and investors like Warren Buffett, have played in the investing revolution. Welcome, Robin. Thank you for joining me. And first off, tell us, what made you decide to write the book?
Well, just the scale of the phenomenon, really. When I started researching and writing about index funds, spending a large part of my day job at the Financial Times on it, it was, well over $10 trillion in index funds. And we know that is, frankly, only a part of it. There are lots of people that have passive strategies that don't invest in a Vanguard or a BlackRock or State Street fund. By the time I started writing it, it was 14 trillion. The book. By the time I finished it, it was 17 trillion. And we're now probably talking around $20 trillion in index funds of various types. So, it vastly outstrips the size of the entire hedge fund industry, the entire private equity industry, the entire venture capital industry. In fact, it's bigger than all those three put together. And I think, although it is passive, I think it's undeniable that the footprint it's leaving on financial markets is also growing in tandem. So it just felt like it was a huge topic that deserved, frankly, the book treatment. But also when I started digging into the origin story, it was also just a phenomenally colorful, fun story as well, right? So when you have the combination of something that's important and big and also quite fun and colorful, then I think, you just have to dive in as a journalist. And that's what I did.
No, I think that's a fantastic way to describe it. Effectively, you followed the money, which brought you to follow the story. And it's obviously been an area of the asset management industry that's grown, exponentially and continues to grow and has had an enormous impact on all kinds of different other aspects of the industry, if we can put it that way. What have people said to you about the book, and what reception has it had in the 18 months or so since it was published?
Well, I was actually quite pleasantly surprised that even though I wrote it for a general audience, I wanted to write something that used kind of the index fund as the humble hero in this journey, but tell a broader story about how finance and investing has evolved over, frankly, the past century. Index funds is not super sexy, not as sexy as maybe I'd like it to be. But the reception has been phenomenal, and it's been quite gratifying to see that, not just from the obvious people that is going to like a book like this. So Burton Malkiel wrote a great review in the Wall Street Journal. He likes index funds. He's one of the pioneers. So I was very gratified to see that he enjoyed it. But also people like Paul Singer, he frankly hates index funds, actually came out and said it was one of his favorite books of the year. And I just quite like that, both fans and, shall we say, skeptics of this phenomenon enjoy the book or found something they enjoyed in it, which was nice, because it means hopefully I struck a decent balance between the positives, which I think are just huge and enormous. I'm a big fan of passive investing, but also the fact that there are undeniable negative side effects from this, as well as there is with any new technology. And that's fundamentally kind of what index funds were. They were the original fintech. They were the first marriage of investing with computers and data. And I think, like all new technologies, there are positive things about it and negative side effects.
Sure. No, I think that's a very good point, that it really was the vanguard of bringing computers into finance, and particularly into asset management. That's a very interesting perspective. I mean, some people that are so-called active managers that, look to beat the market and deliver, quote unquote alpha, they might brand you as anti-active investing. Are you?
No, and it's a good question, because sometimes I find myself becoming a bit almost a cliche of my own opinions. I mean, I think maybe we all do a little bit when we do TV interviews or podcasts and things like that, but we become too unnuanced. And I have, even though the reception has been, really pleasantly wonderful, I have been yelled at. I did have a former Fidelity guy that literally started screaming at me. And I think I am in favor of active management because I actually think it has a societal role to play. Frankly, even bad active management has a societal role because, frankly, it's the noise of good, bad, mediocre, lazy, hardworking, smart, dumb people in markets that actually we do have efficient price signals. And I think, large liquid capital markets are actually a societal boon. They get slammed a lot, and they do stupid things as well in markets, of course. But broadly speaking, it's been one of the primary engines of the modern world. So I'm a huge fan of that. And I think there is such a thing called alpha. I always stress that I'm not a passive jihadist, as I call it. I'm not an efficient markets believer, or at least in the way that people understand that theory. I don't think markets are efficient or semi-efficient. I think there are people that have and do demonstrate long-term track records of managing money. There are people I would invest in if, frankly, they lower their fees or open up some capacity to me. But I think the large majority of active management is mediocre or just noise. And that's not just the day traders on Reddit, but that is also sadly the professionals. And it's not because they're lazy or dumb. In fact, some of the hardest working, smartest people I've ever met in the world manage money in the industry. It's just that it's just so phenomenally hard to do. I mean, I talked to, for the book, a guy called Ted Seides, isn't it? It used to be an asset allocating loss, a very famous bet against Warren Buffett, pitting the S&P 500 against a bunch of hedge funds. And he said something that, stuck with me. And it wasn't the fact that he thought that his own bet was dumb, and actually he might have won it in different circumstances. But it's the fact that he said investing is one of those few areas of life that you might not get better at it. You think you get better. But in reality, we see people's careers do fade out. Their skill sets work in a certain market environment or a certain market era, and then something blows up and they don't work. And also, it's something that you don't always know if you're good or not. Because most things, if you do something well, it's because of your own skill. But in markets, we attribute a lot of things to alpha or skill that might just be blind luck or some sort of underlying hidden factor. And as much as, frankly, most people in the asset management industry will say that, when I do well, it's because of my own God-given genius. And when I do badly, it's because of central banks or index funds. The reality is that it's far knottier to untangle. I've spoken to Bill Gross. He's not in the book, but I remember he said something really stayed with me that, if he'd been born 2 years earlier or 2 years later, you probably would not know who Bill Gross was. But he just happened to come in an era of falling interest rates where his skill set, learning blackjack and measuring up the odds, just happened to be perfectly aligned with the evolution of the bond market at that point. And then he basically rode a massive rally in fixed income for the next 30 years. And, he did it well, and he thinks he did it well. But frankly, if you'd basically in early 1980 gone overweight credit and you stayed there passively for the next 20, 30 years, you would outperform virtually every single fixed income manager on the planet.
Yeah. And I think that's a really good point because, with the bet that Ted made against Warren, he basically bet against quantitative easing, which he didn't even realize was going to happen. And he bet against this almost once in a century type equities rally that continued, year after year, that made people who plugged into that incredibly, profitable, and people who tried to trade around it much less profitable because they didn't understand how the trend would continue year after year after year.
Well, I actually think the impact of QE, I think, is a little bit overdone in that I think a lot of the stuff that people attribute to passive investing in markets, lots of the market phenomena that people, point fingers at passive funds for, can more appropriately be put at the doorstep of central banks and interest rates. I mean, broadly speaking, the big overwhelming force that has reshaped markets in the past 30 years is falling interest rates. That is gravity. Index funds, everything else, that's just detail. The gravity is the falling cost of money, and that has changed everything. But I don't think that Warren Buffett won that bet because it was a uniquely good period for cheap beta, essentially. Because frankly, in most other rolling 10-year periods, except at the very start of the hedge fund industry, when markets were frankly very inefficient and lots of dumb things happened, the hedge fund industry was very small, the passive approach would have still won. And we see that in any rolling 10-year period.
Mm-hmm.
You know, market errors come and go, QE, interest rates wax and wane a little bit. And broadly speaking, the vast majority of people underperform, active managers underperform the market, not because they're bad at their jobs per se, but because of the distribution of gains is so unequal. Like, it's such a top-heavy market. Right now, obviously, we talk about the Magnificent Seven and how they're kind of driving everything. But the reality is, if you look through the history of the stock market, both in the US and internationally, the gains are overwhelmingly driven by just a handful of stocks. So of the sort of 30,000 stocks that have been listed in the United States over the past century or so, I think only 5% of them account for all the $30 trillion worth of gains that have been created. So with 50% of all the stocks that have ever existed in the United States, you would have lost money. And with another 45%, you would have done as well as if you'd invested in T-bills. So all the gains accrue to those kind of mega firms. And look, if you're lucky and guess at one or two of them, then you're made for life. I mean, people like Warren Buffett surfed on certain big early bets like Geico. Even he will admit this, has admitted it. But if you don't get one of those big early bets, one of those big compounders, then you're almost doomed to underperformance, even if you are extremely good at your job.
Absolutely. Now, one of the things that I think is fascinating about passive instruments is, of course, some of the biggest active investors, for example, Bridgewater, but there's others, they've used different passive instruments to build blocks of allocations, to combine different asset classes, macro themes, and sector themes. And surely that is a valid use of passive investments, and in fact, something that I think a lot of people are, discovering and increasingly doing.
No, I mean, this is one of my favorite subjects, actually, because I feel it was something that I didn't quite appreciate enough until I started covering this full time and started researching my book. But, in my book, I position ETFs as sort of the index funds 2.0 or 3.0. And they are quite most commonly associated with passive investing or cheap beta. S&P 500 index fund and the SPDR ETF. It was the first pioneering US ETF. It's the biggest ETF in the world and the most heavily actively traded in equity security in the world. But that second part is the crucial bit. Like, the SPX fund, SPDR, is the most heavily traded equity security in the world by a mile. It beats Apple, Tesla, the whole works. And that's because people use it as an instrument. And although the vast majority of money in ETFs is still in cheap beta and people don't trade it as much as people think, one of the reasons why Bogle hated ETFs was he felt it led to overtrading. But one of the reasons he softened his views a little bit was that in reality, people don't trade ETFs nearly as much as people think. They tend to use it as just a cheap, well-distributed index fund, essentially. But hedge funds, asset managers, pension plans, and so on can and do use ETFs as building blocks. That the ETF has kind of transcended its origin as a pure tradable index fund and has become a far more flexible wrapper into which you can put all sorts of bundles of risk. And I think some of them are heinously dumb and frankly, I do stupid, ill-thought-out marketing gimmicks at best, and frankly, really quite dangerous to financial markets at worst when you lather it on with derivatives and make sort of triple inverse or triple leverage ETFs. I think that is problematic, but it shows how you can use ETFs as a building block. That if you're a Bridgewater or a Citadel or even, an AIG or Prudential Life or something like that, and you have a lot of money coming in all the time, maybe, or a big mandate, and you want to buy a lot of S&P 500 index exposure or fixed income exposure, allocating that slice by slice into hundreds of different companies or tens of different companies might be difficult, or actually you don't want to make those individual allocation decisions. You just want that beta, fixed income beta, credit beta, commodities beta, gold, equities, small caps, whatever. You can do that really efficiently with index funds. And this is why if you talk to people like BlackRock, I mean, it sounds like a marketing line from them, but I think it's actually true. But they describe ETFs as kind of like Lego, and you can build your own fancy castle with it. And I think that's what people like Bridgewater have quite smartly embraced, that you can use ETFs as not a rival, but as a tool, a building block.
Yeah, they're fantastic tools. And obviously the whole passive revolution you've identified is really about developing these tools. And as you've noted, it's been a boon for both institutional investors that we've just been talking about now, but more particularly for, you know, individual savers like you and myself and our children. And, you know, that's saving us money and giving us more choices. So it's broadly all good. But on the back of that, I'd just like to step over and look at some of the, shall we say, softer elements of trillions. We've talked quite a bit about passive and how the instruments are used, but obviously the thing that's most brilliant about the book is how it draws readers in, lay readers, obviously, but also professional readers, like you mentioned. And everyone is swept along by the stories and characters that you've weaved into the narrative. So obviously we have Warren Buffett, we have Bertrand Malcolm, we have Myron Scholes, and even Larry Fink. And of course, the Vanguard founder, Jack Bogle, with whom I think it's fair to say you had a very strong rapport. And in some ways, the story of trillions and of passive investing, is Jack Bogle's story. What was he like as an individual, and what accounted for the phenomenal change he was able to bring to investing?
Yeah, lots of people have asked me who my favorite characters are in the book, and you know, it's like choosing your favorite child. It's very difficult. But Jack Bogle, you know, I think he didn't invent index funds, and he wasn't the only reason why they grew to be such a titanic presence in markets. But it's not unfair to see him as the exemplar of that approach, even though he was himself stressed that he was a cost matters hypothesis guy rather than a efficient markets hypothesis guy. He actually did believe in active management. He just thought that, generally speaking, asset managers charge too much money. And his this story arc was incredible. I spoke to him many times before he passed away. Sadly, I spoke to him just before he was heading to hospital when he did pass away, and it was quite touching that he was, you know, he was very helpful to journalists. He was very much in legacy burnishing mode. But he called me on his way to the hospital saying, look, I don't know if I'm going to come back from this. So do you need anything else for your book or your article? Is there anything else I can send you or get somebody to send you? Just let me know. I'm going to be around for a few more days still. And I was blown away by it. Also because his voice, even though he was old and in generally very bad health by then, he's had many heart attacks and heart transplant by then, his voice still, you know, people at Vanguard called it the voice of God because it boomed with this incredible presence. You can't hear Jack Bogle's voice without picturing him. And he was a force of nature. And I think a lot of that, look, I try to be wary of playing sort of COD psychology with people because people are fascinating and multifaceted, and, you know, we don't know ourselves and certainly not everybody else. But, you know, this was a guy that I think was very much shaped by his background. Like, he came from wealth. His family was wealthy. Both sides of his family was wealthy. But his father became an alcoholic and basically squandered the entire fortune away in the great crash of 29. So he went from having had wealth and being aware of this to actually growing up not poor or destitute, but definitely not well off, having to live in a small house and in a floor in a small house with, you know, two brothers. And because they couldn't afford to send all three brothers to college, they had to send only one, the one with the best grades. And that was Jack Bogle. So his own twin brother didn't get to go to Yale whilst Jack Bogle did. Can you imagine what that does to somebody? The drive, either it breaks you or it makes you. But this was a guy that, you know, had this immense need to succeed from a very early age, and we talked to people that knew him back then when he first joined Wellington. He was a real hotshot, and he loved active management because he loved investing. But then, when he was fired from Wellington later on, when he kind of engineered a really ill-fated merger with a growth fund out of Boston, that just fired that immense drive up to just thermonuclear levels. Several people told me that the only reason why Jack Bogle might seem balanced is because he's got a chip on both shoulders.
That's a fantastic anecdote. No, I have to say that myself, as someone who's covered financial institutions and asset managers, I'd obviously heard of Jack and was aware of some of his accomplishments, but I didn't really understand his character or understand his background. And thanks to you, we now have a fantastic picture of that, and it's an extremely rewarding thing to read about and reflect on. Now, just to change base once again, I wanted to reference the concluding chapter of the book. It's called Our New Corporate Overlords. And in this, you acknowledge some of the real and enormous benefits that these index funds have delivered to investors, which we talked about a moment ago. But you've also highlighted some pretty vexing questions. And in particular, I'm thinking of a reference in Trillions to Jack Bogle himself expressing fear that the economies of scale of indexing could lead to a handful of firms like BlackRock and Vanguard and a couple of others exercising voting control over every major US listed company. And I wonder if the move to build up stewardship teams, both in these enormous asset managers, but also in other ones, to monitor and engage with corporate boards is a sufficient response to this, this exercising of voting control.
Yeah, it's a great question. Obviously, there are so many criticisms of index funds, and I think most of them, frankly, are fatuous, at least a lot of the ones you hear most regularly. I do think, it does have a micro impact on certain individual stocks and certain indices or certain areas. But on a macro level, I think they actually make markets more efficient. I think there's an issue with index construction. I think there's an issue that the industry has with a lot of these stupid gimmicky ETFs that are getting pumped out all the time. But I do think this is the biggest and thorniest issue in the industry. And frankly, if you get people at BlackRock, Vanguard, State Street, and elsewhere, have a drink with them, this is what they'll admit quietly is like they can see why people are worried about this. We are as humans innately worried about concentration of power and corporate power in a world where, corporations do matter a lot, hugely. These are the single biggest owners already, frankly. And if you think of the economics of asset management, but specifically the economics of passive investing, an S&P 500 index fund is exactly the same, whether it's from Fidelity, Vanguard, BlackRock, or whoever else. So the only thing you can compete on is fees. So they compete on fees, and the bigger you get, the cheaper you can produce that fund. So the economies of scale are immense. It just means that, broadly speaking, the big will get bigger and bigger and bigger. So what Jack was conjuring up, and other people have, calculated this will happen in the next 20, 30 years, that there will, if current trends continue, a point where the big three, in reality, we're really talking about BlackRock and Vanguard because they are growing faster than State Street, but let's call them the big three, will control over half the vote of most major listed companies in the US, if not the world. And that is something that I think should give people the heebie-jeebies. I don't think they actually misuse it. And I do think them building up corporate shareholding teams, I think is a good thing. And I don't necessarily think it's not that they haven't got big enough teams. And also, this is one of my pet peeves, is like, there was no golden era of corporate governance. That's complete hogwash. It's baloney. Like, in an era with large dispersed shareholders, the Fidelities, the Capital Groups, the T. Rowe's, the Norges Bank Investment Management, they weren't massively engaged. And I think everybody has been shamed into being a little bit more active. But the reason why groups like ISS and Glass Lewis exist is because most financial investors are that. They're financial investors. They're not proper owners. They just want to, they wanted all the pesky corporate governance stuff. They just want to hand that over to Glass Lewis and ISS and not really think about it. They just care about, the financial aspect of things. And if they don't like the investment, they'll get out. So you could say that index fund, because they can't get out, as long as you're in the index, they're going to have to buy your stock, could actually lead to, in theory, a golden era of corporate governance if they staff up and have the capacity in-house to do so. And I think that is an open question whether they do. The question now, of course, especially in the United States, is whether we want them to. I mean, right now, the backlash is that, these firms are woke capitalists that are cruelly twisting the arms of capitalist companies into doing silly kind of greeny stuff and diverse boards and inclusion. And look, full disclosure, I'm Norwegian, I live in Norway, I care about all that jazz. But I don't think that this is the role of private shareholders to dictate to companies. I think that has to come from elected representatives. So I think when it comes to this issue, it's kind of a damned if they do, damned if they don't. There is no answer to it, but it is going to become an increasingly, if it isn't a problem we can solve, it's going to become a conundrum we have to manage, at least, and think about managing more in the coming years, as frankly, it's just going to become more and more pressing.
No, I totally agree. And I think if there's one positive thing we can take from it, it's because there are so many asset owners of such scale and size, not just the enormous passive holders that we mentioned, but all of the institutional investors across the United States and around the world. They're all taking this pretty seriously, and they're all devoting resources to it. And they're all, in some respects, reflecting the views of their, members and trustees and owners who are, putting pressure on them to engage in these areas. So I think that's a very positive thing compared to this, myth of the golden age of 50 years ago that didn't exist, as you correctly point out. So I think that's a very positive change indeed. Just to, turn the table again, one of the things that we've seen recently is the development of passive investment being applied to fixed income funds. And, that took off after COVID and is now, I believe, up to about 1.5 trillion. I wonder if you could just give us a bit of an update on how this happened and how the mechanics of fixed income index funds work.
No, I mean, this is also one of my favorite subjects, and maybe something I underplayed a little bit in the book, although there is a chapter that deals a lot with some of the mechanics of how this works and how it can go bad, but maybe isn't as bad as people think. But this is one of the areas where I've changed my mind, if I'm being honest. Like I shared a lot of the instinctive skepticism that people have about indexing when it comes to something as fundamentally illiquid as fixed income. People forget that, outside of the treasury market, but even there, frankly, there can be bouts of illiquidity. A lot of corporate bonds don't really trade that much. If they trade, it's by appointment. So you have this classic maturity transformation where we take like a liquid wrapper, like an ETF. Let's use ETFs because that's really the biggest flashpoint. That trade as a stock throughout the day on the stock exchange, that buys and maybe sells bonds that might trade once a week. And people like Carl Icahn and many others have been worried about this for a long time. Carl Icahn was delightfully called Larry Fink on a conference, at a conference to his face, running the most dangerous company in America because of this. I was also worried about this because you can see ways it kind of could break down, but in practice, I've started thinking that maybe the ETF structure is actually superior fund wrapper for illiquid asset classes, because essentially the way it works with the creation and redemption process, I won't bore you too much with the details, but essentially you have ETFs work, they both trade as a share. You can buy and sell them on the stock exchange. That's what most people do. And you can exchange shares with the underlying bond. You can take here's a bunch of bonds, give me some shares in the ETF if they match perfectly, or here's a share of the ETF, give me a slice of the underlying bonds. And you use that to create and redeem shares constantly throughout the day. Market makers do that. And that's how it kind of is supposed to trade in line. And I was worried about what happens if the bond market is struck with a massive bout of illiquidity, and that can't happen. What would happen then? And actually, we saw that in March 2020. The bond market just froze completely in the dash for cash. And ETFs, the creation and redemption process gummed up because people couldn't sell their lying bonds. There was also no arbitrage, but you could still sell the shares in the ETF. So they started careening lower below the price of the net asset value. But first of all, I'd argue that that net asset value was stale. It reflected underlying instruments that weren't trading. The price of the ETF was, in fact, the real price of the underlying bond risk, essentially. And that has like some signaling value. But beyond that, it meant that, you can, if you own a bond ETF, you want to get out, you might have to accept that the price is not where you like it. So you are paying a price for that liquidity. You want to sell the ETF, get out of fixed income, raise cash in a hurry. Well, you can do that. And maybe in March 2020 at the peak, you had to accept a 10% discount to the value of the bonds inside the ETF. But the remaining investors aren't hurt by that because they just sit there. But when it comes to a bond fund, the dynamics, even if you take money out at the end of the day or end of the week or end of the month, you have an incentive, a bank run like incentive to get the hell out of Dodge before the next guy, because bond funds tend to sell the best, highest quality, most liquid stuff first. So you can see this dynamic with fixed income funds where essentially they become trashier and trashier as people pull money out. So the early redeemers, they get out, they get liquidity easy. And it's the remainder that basically bear the cost of that liquidity because they're sitting in a trashier and trashier fund. And that's why you have these bank run-like dynamics around mutual funds that have been worrying regulators, frankly, since the last financial crisis. And ETFs, they don't fix that perfectly. I can still see scenarios where it doesn't work, quite as planned. But March 2020 was hell of a stress test. And I actually think fixed income ETFs came out brilliantly from it, far better than I would have expected before the fact. And that is one of the reasons why we've seen, fixed income indexing has been picking up for, frankly, a decade. But in the last 2 or 3 years, it's really been supercharged. In fact, even in 2022, which was just a terrible year for the bond market, we saw massive inflows into fixed income passive products, especially fixed income ETFs, which kind of sounds weird, right? You have this instrument that lots of people are worried about. Bonds are in the biggest bear market in 100 years, and yet bond ETFs are sucking up hundreds of billions of dollars. But I think it is because they demonstrated greater resilience than a lot of the skeptics would have predicted not that long ago.
No, that's a fantastic point. And I think now with interest rates at the elevated levels they're at compared to what they've been at, for the past decade, that's a trend most likely to continue. But I'm aware of the fact that we've coming up to the end of our time, and I wanted to flag one more question. And it's just a simple sort of looking ahead type query. And the question is, from your perspective, what do you think is worth keeping an eye on in the development of the asset management industry as we look into 2024 and the latter part of this decade?
I've got so much. I mean, one of the reasons why I love covering this is because it will always change and I'll always get stuff wrong, right? But broadly speaking, my overarching thesis, the reason why I started covering passive investing is my belief that investing will become increasingly systematic. Like humans will always be important and all that jazz. But broadly speaking, it helps to look at investing as sort of a spectrum of systematic investing where and cost. So an ETF or an index fund is really just a really simple, dumb, systematic investment strategy. It's to buy all the stocks in the S&P 500 according to the weighting. While something like Renaissance or D Shaw or Two Sigma is systematic but highly complex and very expensive. And we can see a huge migration from, frankly, everybody in the traditional discretionary world into the systematic way that you can't systematize everything. There are certain things that humans are just brilliant at that I don't think even like the most godlike AI will be able to do quite as well. People forget that the human brain is a pretty powerful computer in its own right. But there is a lot of stuff that will just be and is a lot easier with computers. So I think that, frankly, despite it's being talked about for so long, I think people still don't have their arms around the broader implications of that, especially when it comes to like how we regulate financial markets or look for risks. I think that's just fascinating. And I think, like, I mean, as much as I'm a big fan of ETFs, index funds, there is undoubtedly going to be accidents there, just because, frankly, now they're in every segment of the financial markets that, you know, if there is an accident, there will be an ETF there or nearby the scene of the crime, as it were, and they will have an impact. I remain worried about leverage. I mean, it's such a classic thing to worry about, such a cliche, but it remains true that the mix of leverage and illiquidity can be toxic. But actually, broadly speaking, I end up being far more optimistic than maybe most people expect a financial journalist to be. Because I actually have this little cartoon that somebody had in 2008 made up that, you know, there's a guy on an airplane and the captain is saying, oh, please put on your seatbelts. There's going to be a bit of turbulence. And there's a guy on the plane screaming, we're all going to die. And the passenger next to him says, relax, he's a financial journalist. And we have a tendency to be scarred and we always look for the downside. But broadly speaking, look at 22, right? We had this massive ramp up in interest rates around the world. And if you told me the scale of it before the fact, I would have predicted absolute carnage. Not asset prices go down, which is, you know, frankly, a normal part of life in financial markets. But I would have predicted quite major accidents after the low rate era that we had. And broadly speaking, I think people did learn a lot of lessons from 08 and some of the mishaps we've had since then. And we'll forget them in time. But broadly speaking, maybe I think, yeah, the one thing I'd keep my eye on is that maybe we shouldn't be so god awful pessimistic all the time. That people will have accidents, people will lose money. I'll have plenty of stuff to write about, fun stuff to write about. But, you know, the great game will continue.
That's a super encouraging and highly optimistic note to end on. So we'll bring our conversation to a close there. Thank you, Robin Wigglesworth, author of Trillions, and of course, the FT Alphaville editor. Thanks, everyone, for listening. This brings to a close a truly fascinating and insightful edition of the Peregrine podcast. See you all again soon. Thank you.